All right, welcome back, everyone. We're excited to continue our discussion and transition the dialogue to focus on tax-efficient supply chain management. So we'll build on some themes we just talked about and really keep the prospective forward planning going. So for this session, I'm going to welcome back Ron, Brian, and Kathy, and I'm going to introduce a new panelist, Pete Byford. Welcome, Pete. It's great to see you this morning.
Hey, Matt. Great to be here and looking forward to chatting. Just to give a little background on me, I am a director with Bekaert, and I work in our new market tax credit finance department, helping folks finance large capital projects.
That's great, Pete. Yeah, thank you for the quick background as well. And so obviously those that were on the last session know Ron and Brian and Kathy now. So now you've got a lay of the land on our panelists. And really our goal here is to carve this topic up into a few different buckets and then really bring it all back together. And our intent to do that is to kind of walk through what we'll call a case study, highlighting a holistic approach as we see it, really how to create an optimal tax efficient result. So with that, and I guess really quickly, as you can see on the screen, just a reminder on the CPEs, we'll have some polling questions throughout. So please answer those. Please stay on for the entire 50 minutes to get that CPE. Again, we launched a survey after the last session. There'll be another survey after this. So we appreciate feedback, again, not only on today's topic, but again, topics that may be of interest going forward. And then we'll be sure that these recorded sessions are sent out to all of you listening. So again, we appreciate your time. And with that, Ron, I'll hand it over to you. And why don't you dive into the first part here, and then we'll collectively walk through it.
Great, thank you, and welcome back, everyone. We look forward to spending the next 50 minutes with you talking about tax efficiency within the supply chain challenges that we currently face. So we are going to cover three items. We're going to discuss current and near-term supply chain challenges. We're going to share with you the optimization strategies that we see where you can utilize federal and state tax law as well as financing via Peter to assist you in the supply chain, in essence, rebuilding it. And then we'll provide you some roadmaps for some establishing some tax efficiencies. So it brings us to our first polling question, actually, in regards to, has the supply chain negatively impacted your organization? We've got to give everybody a few minutes. We have about 85% who have voted.
Ron, it's looking like that's a runaway poll there.
Let's then share the results. So when you think about, has the supply chain negatively impacted your organization, 87% of you indicated yes. For those 13%, you should feel yourself very fortunate. And so why do I say that? So, let's kind of talk a little bit about tax efficient supply chain optimization and some background items. To my Mark Twain comment in the session, we always want to kind of lay foundational facts and then we can apply them and plan for them. So based on a survey that was done, greater than 50% of middle market executives reported that supply chain challenges during COVID negatively impacted their organization. And specifically, when we think about sourcing and components, they were centered around the supply chain, specifically China. 72% were impacted from a sourcing and raw material or component. 58% attributable to Europe, South Korea, 41%. And then yes, even in the United States, what is occurring is that we have supply chain, what I call breakage in the elasticity, if you will. So when you think about tax efficient supply chain optimization, there's really three broad themes that are currently happening in the challenges and elasticity. First of all, there's optimizing my current supplier network. There's also upgrading the technology because of the COVID impact. And then third, which I'll speak to, is the creation of really what we see as a rigorous demand for forecasting process when it comes to inventory and raw materials. So when we think about optimizing a supplier network, what we're talking about here is, dual sourcing and dual tooling. Back slide, please. And so when you think about that, that what's happening in the supply chain because of the inability to deliver raw material and components, industrial companies are pivoting to dual or really even triple or quadruple sourcing in regards to raw material, components, tooling. They are selecting and pivoting to multiple suppliers. And then ultimately they want to leverage technology to improve the visibility chain. And this is all about actually optimizing that supplier network. The second theme I mentioned, which is about upgrading technology. So there's 75% of manufacturing executives, based on a survey that was completed, indicated that they plan to increase their technology spend, specifically in the following areas: monitoring data from supplies or raw material to ultimately logistics and transportation. So they're looking to apply it throughout the chain. They're looking at granular inventory management because of the inability on components and raw material that they need in the manufacturing sector in regards to being able to produce their product. They're trying to analyze through technology supplier risk management. And what I mean by that is that what we're seeing is an element of digging actually into your suppliers' chains. So you actually are looking at elongating the chain from the standpoint as you're being able to see real time what's happening at a supplier or a dual or triple supplier, i.e. you're building deeper supply chain relationships. And so that's what we talk about when we think about upgrading technology. And then the third item, which next slide is important, is really the creation from an industrial perspective of a rigorous demand in that forecasting process. Because ultimately, if I can't manufacture, I can't deliver to my clients, then ultimately that is a negative impact, as we saw on the poll. 80+% were being negatively impacted as an organization is attributable to the supply chain breakage or elasticity that is occurring. Elasticity, basically the elongation of the chain from a timing perspective. So what's happening in forecast process improvements is leveraging analytics. We last week talked a little bit about that in our digital team. We are moving more, or what we see in autonomous lights out factory concepts, a lot of simulation planning, specifically in the event of the line or multiple layers of the line in a repair and maintenance perspective, and then ultimately really moving more to a demand forecasting as opposed to the old demand planning. So I wanted to lay that foundation to my Mark Twain comment or quote. So when you think about supply chain tax complexity, because this is all about how do I use federal and state tax law and opportunities to have the government provide subsidies to me as I'm rebuilding, because that's ultimately what you're doing. You're rebuilding the supply chain, you're optimizing your supply chain, and you're creating tax efficiency in doing it, because tax is intertwined in the entire chain. So as you saw, most companies, industrial companies, have a global supply chain with numerous moving parts from a demand forecasting perspective. You're evaluating changes in a component that can affect the supply chain, the dual sourcing, as I refer to it. Just the nature of global supply chain presents an opportunity to generate tax efficiency, whether that's on the ITAX side or the SALT side. So when you think about a supply chain and the major taxation points, this is really the chain as we see it from start to finish. And intertwined in all of these taxation points is in fact planning opportunities from the strategic planning and forecasting to ultimately the transportation or the logistical element, but specifically as well in the consignment or dealer or direct consumer perspective. So when we think about strategic planning and forecasting on the federal side, next slide, please. Here are the 7 areas that we see that federal and state, whether it's a credit, a deduction or rebate or an exemption, can assist. And as we talked about Build Back Better, we know that a lot about Build Back Better, specifically in the pharmaceutical industry, but really across all industries, is to really have the supply chain resident, if you will, in the United States. So we start with site selection because we are seeing significant new facilities being built and or existing facilities being entirely renovated to create greater efficiency in regards to the production or the lines, but more importantly, there's an element of tax planning opportunities here. And we'll speak a little bit about that in our case study. Cost segregation studies, which is simply coupled with energy efficient subsidies and credits in the statute, is a significant way to help pay for these new or existing facilities when you think about the renovations. And of course, everyone is very focused on energy as a result of what we see going on in our economy. We spoke a little bit about Build Back Better and some of the planning opportunities and inventory methods and inflation and LIFO and low of cost market or FIFO. So an analysis of the inventory method as well as uniform capitalization rules is important. All of these are intended for the government to assist you in regards to subsidizing the tax efficiency in the supply chain. When we think about research and development that I touched on in the first hour, you're re-establishing production, creating greater tax efficiency and optimization. And obviously there's research and development opportunities or credit opportunities or both at the federal and state level. And when we think about facility management, we're seeing more of this from a federal perspective and state perspective, and deductions, rebates, exemptions, subsidies that can assist you in really warehousing more from a robotic perspective. And of course, subsidies are there at the state as well as federal level. And then what we see to the lights out comment is that everyone is very focused on energy management systems because as an industrial, it's probably your second or third largest cost item. And then state credits and incentives are significant depending on the state, specifically when we think about jobs creation credits, when we think about training credits, and the like. So these are 7 areas to keep in mind when we think about the federal side and some state side in regards to tax efficiency. And we'll talk a little bit about this as we go through our case study. So I'm going to turn it over to my colleague, Brian Dill, on the international side.
Thanks, Ron. First slide, let's start off with a polling question. And so I think the big question is, with regard to your policies and procedures in your companies, which areas from a tax perspective do you focus on when you decide or want to make changes to your supply chain? Looking good. Getting close here. All right, I think we're going to go, it looks like 43% of you say all of the above. Congratulations, that's what you should be doing. I think in the global supply chain, there are several areas of taxation, and it's not just the end user perspective. And then so anything that changes, you should be evaluating that. So this has already been brought up, but I think it's important to reevaluate, to refocus here on tax complexity in your supply chain and changes to that. I think one thing that we do here at Cherry Bekaert is certainly when you're trying to adjust your supply chain, what are the efficiencies we can drive out of it from a tax perspective? I mean, the long game is, the bad thing is if you save 30 cents per dollar from a cost savings, but you give 90% of it back from a taxation, that's a bad thing. So what we do a lot of times is help you enhance your benefits and your cost savings by also thinking through the tax supply. And we all know that through the last couple of years of COVID, governments are strapped for cash, and we really do expect tax audits to ramp up. You know, you've seen it in the Build Back Better bill with proposals for more agents. You're seeing that across the world. So changes to your supply chain, I think, will involve and attract more tax audits. Major taxation points, I think I just wanted to refocus here that what we see a lot of times is that people or clients believe that the taxation point from an income tax perspective is always, to the end user or to the seller. That's not the case. Taxation can occur at any point in your supply chain and can drive inefficiencies. I think this is a perfect example. This is a real world example. I changed the numbers a little bit, but it was a big surprise when they made changes to their supply chain because of the way the rules work and because of the contracting that occurred in the supply chain. What happened was there was non-refundable VAT that occurred, an indirect tax. And because of inefficiencies in the crediting position, the taxation on this was effectively 71%. And it was a big surprise to the client. But inefficiencies in the supply chain can really drive this. Shifting to the next slide is really what we are seeing in the COVID-19 environment. I think you've all seen virtualization of your workflow. What's going to happen there? How are you going to deal with that? What are the taxation points? We're seeing a big shift to going direct to consumer market. How is that going to change it? Are you ready in a direct to consumer going into a foreign country? Are you ready to collect and remit taxes? I think Kathy will talk about on the SALT side, but we also see that on other countries collecting VAT, remitting VAT, digital taxation that's occurring when you're using apps and delivering digital services. So your supply chain, if you're going to go direct to consumer, is a big deal. Diversifying your manufacturing and sourcing footprint. I think we're seeing, near shore, offshore, those type of things. And what's the taxation effect? And then the other things, multi-tier supply chain. I think we're seeing people wanting to have different sources, but when you run different sources, there are different lines of taxation that you are having to collect and remit taxation, maybe in several countries. Are you ready? Do you have the resources in order to go that line, not just from a multi-tier supply chain, but also a multi-tier taxation chain? So what we do here at Cherry Bekaert really is, we integrate our tax planning into your overall management of your company. And that really, what we have seen over the years is that can materially affect your supply chain cash flow and overall profitability. Like we said, if designed properly, a lot of times it can be a tax savings enhancing with your cost savings as opposed to an inefficient tax structure. We're big on integrating with your global tax strategy with its business operating model. We think that drives efficiency. We think that drives overall cost effectiveness from the start, as opposed to tax being an after the effect. We've changed our supply chain. Let's decide or determine what the tax effect is. That is last century thinking. Your tax team really needs to be part of your supply chain management team to go step by step to make sure, because the government thinks it's part of your supply chain. The government thinks that it participates in part of your supply chain. So you should be staffed and effectively managed from that perspective. And then we really do, from a transfer pricing, how do you allocate your functions, your assets, your risk? What's the intercompany pricing in your supply chain? I think if you've seen out there, that is always the big deal, is what is the intercompany pricing? Because governments ultimately want a split of your profit in their country in order to determine your taxation bill. So what do? We benefit companies that do business internationally, which need to improve operating performance or reduce tax expense. So it's not just a tax play. A lot of times, if you're looking to improve operating performance, tax can be right there and enhance your operating performance by saving from a tax perspective. we either do, from a supply chain management perspective, we either do full scope of business processes through our intercompany pricing, our transfer pricing team and consultants, or we do specific processes or specialized entities, whatever that might be. If you're looking at setting up a distribution company, or you're looking at supply chain management from your suppliers, we do both of those. And we are big on integrating with your team because we think there are many moving parts and numerous interdependent and interconnected transactions. We like to work with your team and be part of your team because there are just so many moving parts, from IT systems to your legal counsel, that we work from those perspectives. So what's our overarching objectives here? We develop, we really think, if you have benefits in your supply chain, how do we safeguard those benefits so that they are not just a one-year benefit, but they last over it? Neutralizing threats. I mean, that's no joke. That's tax audits that are going to occur post-COVID, that are going to be ramped up as governments come back online. Their tax agencies have been offline or very limited for the last couple of years. We fully expect that to come back in line in the next couple of years and have enhanced focus on tax audits. And the big thing we do a lot of is we create the proper documentation to support your positions, to evidence your pricing. That is just a big deal that we see, is that a lot of times you put supply chains in place and you don't have the right documentation to support it. And that just invites a tax audit and tax adjustments. And live the structure. What do I mean by live the structure? I really mean that what is the appropriate accounting entries? What are the appropriate changes to your accounting systems and tax reporting that need to be done? And then finally, maintain the structure, the annual updates to your documentation, what happened in your structure, what functions, what people left, where did you decide to outsource or insource? Those things are big changes and also have taxation effects. And so what are our services that we do from a supply chain perspective? Business model transformation, I'll let you all read that, but I think the big ones are business model transformation. We are doing transfer pricing is a big deal that we do all the time. I think what we're really seeing a lot of is that, especially with the China problem and getting goods here, we're seeing a lot more companies evaluate nearshoring and what are they going to do from an offshore perspective? How are they going to handle that when that is not part of their integrated supply chain? How are they going to do that? Profit accumulation, you accumulate profit overseas. What's the taxation effect of that if you've operated overseas in your supply chain? And I think a big thing, more important is when you do a supply chain and you have growth projections, is your structure, your legal entity and tax structure, is it scalable to grow as you grow? I think a lot of times what we see is people that put a supply chain in place, but they put an organizational structure around it that can't grow and keep up with their supply chain. And so we do a lot to help companies manage and put in place a scalable structure around that. I'll turn that over now to Kathy and state and local taxation.
Great to be back. Okay, let's talk about some SALT considerations of supply chain. And things to keep in mind. The first one, legal entity formation and structuring. Just like when you're an individual and you're domiciled in a certain state, and maybe it's a high tax state and you want to move to Florida so you're not paying any taxes, you have to move your stuff, right? You have to move your domicile, you have to move your residency. And so at the business level, you're looking at the same concepts. Where's your stuff? Where's your manufacturing? Where's your distribution? Where are your people? And if they're in multiple jurisdictions, those are, you want to take into account all the state and local tax considerations of having these operations and functions in all of these different states. And that starts with legal entity formation and structuring. There are opportunities, especially in a C corporation context, where if you are filing in some separate return states, meaning that you only file a tax return at an entity level, you cannot file combined, versus unitary states where you file as one big taxpayer, you combine all your entities and file as one taxpayer. For if you have a lot of income in these separate return filing states, There may be some opportunities to contain nexus where, say, for example, you have warranty or other services. If you isolate that in a different entity and put a box around it, maybe you can isolate nexus. So those are things to consider for just entity formation. How can I most cost effectively set up our entity structure to minimize state taxes? Opportunities to isolate profit and loss as well. So we have transfer pricing between entities, what functions are occurring in which entities. So it's kind of like a big puzzle at the state level. You have all these different things, all these different states, all these different rules, and it's a big puzzle to optimize that. Commercial domicile, people do not think enough necessarily about that. Delaware is always the state that attorneys want to set up corporations and organize within Delaware. But unclaimed property reporting, if you don't have a state of last known address, all of that unclaimed property actually goes to Delaware. And Delaware, they receive a third of their revenue from unclaimed property. So if you have had the opportunity to go through an audit with Delaware and unclaimed property, it's very painful. But with regard to commercial domicile, if you have types of income that are not apportioned, they're more allocable portfolio type income, generally that gets allocated to commercial domicile. So you have all these different nexus and apportionment things happening at the state level, a lot of different jurisdictions. Some jurisdictions don't even have an income tax. Some have different types of tax structures. So it's this puzzle that we want to put together. Changes to business activities. So anytime you're changing the location of people or functions or business activities, you want to look at the SALT impact of that on your supply chain. Again, I mentioned the nexus considerations, but also Public Law 86272. If you can isolate activities that are jeopardizing that protection, maybe you can still take Public Law 86272 position for some of your operations. Now, there are some states that look at if one entity has blown Public Law 86272, they've all blown it if they're related. You have to work through those. Apportionment implications. General apportionment formula for the state. Generally, you either have a single factor sales formula or a three-factor formula. So if you set up operations and you have a lot of people and a lot of property in a state, it's very beneficial to have a single sales factor because you're not harmed. The more investment you make in people and property, your tax doesn't go up in that state. So that's an example for apportionment. And then also there are states that allow a manufacturing alternative apportionment as well, where I don't have to use the three-factor if I'm a manufacturer. I may be able to elect a single factor or may be required to use a single factor. One of the other considerations in supply chain from a state tax perspective that very important is to consider our throwback sales. In this situation, especially California is just notorious for this. If you are shipping product from a California warehouse to a state where you're not subject to tax, that gets thrown back and considered a California sale. So where we can plan, we're not going to want inventory in throwback states because you can literally have nowhere sales where you don't have to assign those sales to a specific state. And we want to look at the SALT considerations whenever you're entering a market, as Ron indicated, from a state credits and incentives perspective, as well as exiting a market. COVID implications. Again, I touched on this, but that was a change, right, to our functions. All of a sudden, we have people in different states, maybe not for all of you, but for many, all of a sudden we had a change to where our people and functions are occurring. Again, we want to look at that state guidance for the periods that we can, but we have to analyze that change from a nexus perspective, from an apportionment perspective, also payroll tax perspective, income tax withholding, unemployment. If your employees are in a state that has some of these additional payroll taxes like mental health and disability taxes. California is notorious for additional payroll tax requirements. Also, even from an international perspective, do you have a remote employee that's working in a different country and you have all potentially international considerations with regard to that? And the other thing I want to mention with COVID is that if you do have incentives and agreements in place, and you have had to make substantial changes due to COVID, reduction of workforce, or your workforce is now in different states, have you committed to meeting certain milestones or certain hiring levels in a state that you are now not meeting? You want to go back and look at those agreements, and you want to see what you can do, because you may have clawback provisions where you have to pay back those incentives if you are not meeting what you had agreed to. And indirect tax considerations. Oftentimes this is overlooked, but sales use tax, manufacturing related exemptions, procurement and transportation functions can have a significant impact on your indirect taxes and how you set that up. Intercompany transactions, you could have intercompany transactions that actually create tax that didn't even exist before. So you want to analyze your intercompany transactions when you're looking from a state and local tax perspective. And personal property tax, there are 14 states that either fully or partially tax inventory. So obviously, again, better not to store your inventory in those states if you have significant volumes of inventory. And then certainly the license taxes, gross receipts taxes, net profits taxes come into play. So you can see there are so many different areas of SALT that can come into play within the supply chain. So in order to most tax effectively optimize that process from minimizing your overall effective rate, you want to dive deep within each of those considerations. And this polling question, we consider the following state and local taxes in our strategic planning, or do you even look at state and local tax in the strategic planning? Because sometimes it could be a terrible surprise at the end of the day, and no one likes bad surprises. Income franchise tax, sales tax, property tax, all of the above or none of the above. You can be totally honest, and we aren't tracking these answers per person. So I am really, really pleased to report that it looks like all of the above are considered, which I am very happy about as a state tax professional, very happy that you're considering all of those state and local taxes. Keep us in mind if you need help in putting that puzzle together as you move forward. Thank you. Pete?
Yeah, thanks, Kathy. And now I'm going to dig us in even tighter from states down to actual census tracts, but to talk about new market tax credit finance, which is a federal tax credit program designed to inject capital into low-income communities. Program is administered through the Department of Treasury with an organization within Treasury called the CDFI Fund, and is operated really nationally through a public-private partnership between the CDFI Fund and private organizations called community development entities. While it provides a substantial subsidy in projects that qualify, it's a highly competitive, and unlike, say, a historic tax credit or a work opportunity tax credit, there's a finite supply issued annually for financing. Next slide. So as I said, it can be a substantial subsidy. Anywhere from 17 to 20% of your total project costs can be covered by equity generated through the New Market Tax Credit Program. Typically, that money comes from a tax credit investor who actually acquires the tax credit in exchange for capital. It gets paired or leveraged with other sources of capital you may have, and that can be very flexible. It can be your own equity, it can be third-party debt, it can be sort of drawing off an operating line of credit, state grants, as long as the granting documents allow for that, same with federal grants and other dollars. The benefits are the money comes in, that 17 to 20% of cash comes in the form of a subordinated loan, typically comes with a 0 to very low interest rate at an interest only for 7 years, which is the amount of time it takes the investor to recoup the credits. And then at the end of that 7-year period, typically that loan is sold back to your organization for a de minimis amount, say $1,000. And so the technical way it operates is, as I said, highly competitive application process from these private organizations called community development entities. And they have a specific investment strategy to generate change in low-income communities, for which they provide an application to Treasury and say, hey, if you give me credits to sell in exchange for equity, I will invest that equity into transactions that generate the following returns. And many times that is creation of quality jobs. Industrial is one of the best places to create those kind of quality jobs. So the CDEs submit a representative pipeline of projects and then are always on the lookout for folks who are doing capital expenditures in low-income communities to generate the types of returns they want, which are, in this case, high quality jobs that are accessible to people with typical barriers to entry. As I said, when they receive credits or allocation authority, as we call it, from the Treasury, they find a tax credit investor to invest equity in the community development entity in exchange for those tax credits, and then loan that money to projects like you may have in order to finance capital expenditures. And we'll talk about what those can be in a few minutes, but it's a very broad range of what costs can be covered in that. Now, as I said, we're really drawing geography down. We talked about international tax. Kathy just talked a lot about state considerations. The New Markets Tax Credit actually is driven by the 5-year census tract data. So a low-income community is defined as a census tract with poverty in excess of 20% or median family income below 80%. Now, because it's a highly competitive program, typically CDEs will invest in projects in areas that we call areas of higher distress. So on a primary test basis, that means poverty is over 30%. Median family income is less than 60%. Unemployment's more than 1.5 times the national average, or you're in a non-metropolitan county within the country. There's a laundry list of additional criteria. If you meet any one of those 4 I just named, you're in a higher distress census tract, or you can identify any 2 from that longer laundry list I won't bore you with to qualify as an area of higher distress. Now, the good news for most industrial folks is you're looking at industrial sites, which typically are located in areas of lower family income or higher poverty because of the industrial uses in the area. So once you're in a qualified site and you have the kinds of impacts that folks that CDEs are interested in, then we structure this financing transaction to generate the capital necessary. Importantly, that capital can come in either prior to construction or acquisition of your capital project, or it can come in during the middle of that capital project, depending on the timing of the New Markets program. And it can be used for a wide range of impacts. So it can be used for the acquisition of land and construction of a new facility. It can be used for expansion or renovation of an existing facility. It can be used for acquisition of machinery and equipment, working capital while you're ramping up that machinery and equipment coming online or that new facility coming online. And it can also be used for the acquisition of a new business or to vertically integrate. Typically, projects need to be at least $5 million in capital costs, and you really get some synergy. It's complex financing, so there are a lot of frictional costs to the transaction, but start at minimum 5 million and you really start getting traction at 10 to 12 million dollars of transaction value. Interestingly, or importantly, CDEs can finance all or a portion of a project. So I'm going to show you 2 examples here. The first is a company called Swiss Chrono, a company owned, not surprisingly, by a Swiss family that makes engineered hardwood flooring all around the world. They have a location in Barnwell, South Carolina, where they made engineered hardwood flooring, and they were getting absolutely killed on the cost of bringing high density and medium density fiberboard in from manufacturing facilities in Alabama and Virginia, because that's the meat of a piece of engineered hardwood flooring. And they decided to commit capital to build their own high density, medium density fiberboard manufacturing facility co-located to their flooring plant. 250,000 square feet, created 272 direct jobs. We actually ran a calculation. These are community development organizations, so they're looking at all types of returns. they reduced their emissions footprint from that traffic for fiberboard by 2,500 tons annually, and created jobs in an area with high poverty, high unemployment, non-metro area. It's also a FEMA disaster area and a federal promise zone. So you start layering all those things together and it becomes a very attractive project. Now, the Swiss Chrono project is a very large, $230+ million, with $45 million worth of that cost financed through the new markets mechanism. On the other side, you'll see Vestal Manufacturing, a facility in Indiana, family-owned business that was expanding their facility, adding another 225,000 square feet, creating or retaining almost 570 jobs. As you can see, $14 million in project cost, $8 million of allocation financed, or $8 million of project cost financed through the new market tax credit program, and really changed the face of a tiny little town called Angola, Indiana. So with that, I will take us to our polling question and just ask, with everything that's going on, what types of capital projects do you anticipate having in the next 24 months? Is anyone looking at a new facility, expanding a facility, overhauling equipment, acquiring a business, or are you holding back to see what's going to happen economically? All right, we're about halfway through the time and about 75% of the way through responses. So get your answers in before we run out of time so we can get you that CPE credit. All right, looks like we've just about got everybody in now. Just a couple seconds left to throw an answer on the board. All right, and so you can see we've got a spread of folks who are doing various projects, and then the leader in the pack is none of the above. Certainly understandable with the uncertainty in tax situation right now.
Hey, Pete, thanks for that. And yeah, I'm still looking at that poll that's up on my screen, and it's certainly I think we've got answers across the board, which is interesting. But also, I think to your comment on the none of the above, it's we're certainly not getting any favors with all the uncertainty. So that certainly weighs into a lot of decisions that are being made or forecasts that are being built. So what we wanted to do here was, now we've talked from a federal perspective, an international perspective, a state perspective, and even with Pete's commentary there, even at a more of a micro geography perspective, just some of the things that businesses are thinking about and evaluating as they evaluate their supply chain. And in doing so, how do they ensure that they don't end up with an example like Brian shared, a 71% tax rate, reducing after-tax dollars. So if we go to the next slide, we're just going to share I'll call it a simple fact pattern here. I won't go through all of this, but then really wanted to, more in a panel style, get our speakers to kind of weigh in on what they'd be thinking about and how businesses should think about, this opportunity here. So international PPE manufacturer constructing their first U.S. facility to support some of the supply chain issues they were having from shipping products from Asia to the U.S. had historically been distribution only. So not only just a new facility, but a pivot in the model. And you can see some numbers here on just cost of projects per project and number of folks that would be employed as a result. And then really the major needs for the project. I mentioned a bit about the distribution and importation, also access to raw materials, inventory management. So we've got a couple elements, and hopefully this will bring that holistic approach we mentioned at the beginning to some of the dialogue we've kind of gone through here. So recognizing right out of the gates, we're talking about a multinational here. Brian, why don't you kind of throw out some of the first things that you think about that could be potential pitfalls or maybe the other end of the spectrum, opportunities for a business like this one in this example that was kind of thinking through this.
Certainly. Thanks, Matt. I appreciate it. I think what we do a lot of times is, when companies are focused on the actual operating supply chain, what we come in and do is kind of turn things on their head a little bit and think, you're going to make money here in the United States, but then you have to get all those monies back to the foreign parent in this case. Well, how is that done? And we come in and we talk, well, who's the client base? Is it the existing client base of the US company, or is this a new market for them? How are you used to arranging your manufacturing facility? Maybe we could think about a contract manufacturing arrangement where most of the profits end back up in the foreign parent, or a tolling operation. What about this new direct to consumer market? Do you have a third party distributor? Do you manage the distribution relationship? Is this an e-commerce platform? All of those factors about this new development of a manufacturing in the United States drive ultimately the global tax rate for this company, and how you arrange that and think about those things up front are what's going to drive ultimately what the supply chain looks like, both from an operational and a tax perspective. And that's what we help clients think through, is the legal, the treasury function, the client customer, the invoicing, all of those things that need to be taken care of from an international perspective. And then I get Kathy involved in the state and local, where we're going to locate the facility. I get Ron involved on the credits and incentives, because all that goes into the ultimate tax planning from a global tax perspective. Thanks, Matt.
Yeah, that's great. That's great, Brian. And I think you kind of segued nicely too, because I was, and like you were, and kind of as we see with our clients from the state perspective is, then how do we think about it from a, where do you locate? What do companies need to be cognizant of as it relates to, I know Kathy touched on earlier, Public Law 86272 and other things. So Kathy, just as you're thinking through this fact pattern, what are other things that just jump out at you as again, maybe pitfalls or opportunities to frame it up?
Yeah, the biggest thing that jumps out is that if you're going to make that kind of an investment and that many new jobs, you have a lot of credits and incentives opportunity at the state level. And generally, in order to get the negotiated type incentives, you're going to need to pit a couple states against each other. So you're not going to want to announce anything. You're going to want to be talking to the various states and what's the best package they could put together. And then when you have a competitive situation, you can negotiate the best incentives package. But then even beyond that, and incentives packages, by the way, can be property tax exemptions, grant, sales, use tax exemptions. Jobs credits are usually statutory. But beyond that, though, you really want to make sure, even if a state is going to give me the best incentives package ever issued to anybody, what's the long-term implication of being in that state? So you really want to model out what all those different state taxes are that I had mentioned previously from a long-term perspective, because you might get some exemptions for a short term, but then at the end of the day, if you end up paying more in the long run, you want to make that decision knowingly. So I think modeling out the state tax impact is really important. For example, just a quick example, state of Virginia, I think personally is a terrible state because they have a 3-factor formula generally. Now you can elect a single factor as a manufacturer if you meet certain salary requirements for the manufacturing jobs. But they have generally, outside of that election, anytime you're increasing property and payroll, you're increasing your apportionment to the state. They have a local tax, which won't apply to manufacturers, but if you're providing any services at all, and those services are performed in Virginia, you may have to include the revenue attributable to those services, both in Virginia and other states. So Virginia could be okay, in certain situations. But for service providers, for sure, it's not a very friendly state. So there are certain states that are friendlier than others long-term. So I think it's important to negotiate, the best incentive package you can get, but then also to make sure you're actually modeling out what do the taxes look like once those incentives expire.
Well, I'll take my Virginia resident hat off here. No, but completely understand, because certainly we see that quite a bit. And, and I think to your point, it's not making a rash decision. It's really modeling out, as Brian noted, from an international structure, from what state and how that's going to be structured, what the long term is. I think going to Pete, and Pete, you just touched on it a bit. I think there's also, the consideration of how else can we pay for this. So, I think maybe commentary you might have on, again, that what's the first step in figuring out, kind of going back to your dialogue on figuring out, is there a new market tax credit opportunity here? Yeah, Matt,
and Kathy, this is a great sort of highlight of how a holistic approach is really valuable. For reasons I won't bore everyone with, Virginia has just become a really exciting place for new market tax credits. It's become what we call an underserved state. And so now folks are really looking to dump a lot of new market tax credit allocation into the state of Virginia. But to your point, if a short-term capital gain of capital comes in through new markets, but then you bleed it off over a 10-year lifespan in a 50-year facility, is that really the best place to be? And so, Matt, as we look at projects with clients, we try and always first let the business decide where they need to be. Do they need to be near rail? Do they need to be near interstate? Do they need to be near the port? What are the things that they need? And then within that sort of tight box that they may draw in 3 or 4 states, as Kathy's helping negotiate incentives, we'll help identify, okay, if you get to a place where all other sites are relatively equal, these two can generate new market tax credit returns, or these two are, one of them is an existing facility that could qualify for abandoned building tax credits in the state of South Carolina, or historic tax credits in the state of Virginia. The types of things that can bring capital to the project and really reduce the cost of capital over the long haul of your facility. So it really does become, I think of it as a circle, and you have to start somewhere, but you eventually need to run all the way around it 2 or 3 times to make sure that each decision you make isn't throwing something else way out of whack.
Yeah, that makes sense. And Ron, I think wanted to give you a chance too, because I know as you were going through your presentation, I mean, when we talk about how do we create tax efficiency, I know you touched on some opportunities, cost seg and R&D. So maybe your thoughts on just, again, how you think about this or model it out.
Well, not dissimilar. It is to Pete's comment or Brian's or Kathy's, but the way we approach tax efficient supply chain, optimization is a holistic approach, because as I indicated kind of in the early part of the presentation, is taxation is intertwined in your supply chain. And we want to make sure the chain is as efficient as possible. So in this, case study, we're presenting, Kathy correctly touched on, the site selection, and, really this would be a new facility. So, we want to look to what are the opportunities from a federal tax law perspective that we can, utilize tax law to minimize either the tax liability and or create subsidies attributable to the project overall or the build. So when you think about building, as you said, Matt, cost segregation comes into play. This is a brand new manufacturing facility, so it is likely in the PPE area, just given COVID, to be somewhat of a state-of-the-art facility. So we're going to look to that $50 million of building to say, well, what can we immediately expense, and what costs can we also associate with, a credit or an incentive or a deduction or a rebate that either the federal and or state government can assist us with. Kathy touched on, the employees. So, we certainly want to look at, the job creation, the job training, really anything that is attributable to that employment factor that we can gain. Again, as I like to say, when you think about credits and incentives, they come in 4 buckets: credits, incentives, deductions, and rebates. So when we look at that building, we're thinking deduction. When we look at the equipment, we're talking about, maximizing that deduction. Now, state of the art, it's all going to be energy efficient driven because of the manufacturing facility. It's going to meet likely local codes. So there's, no less than 100 provisions that deal with energy efficiency, whether we're talking about an HVAC system or whether we're talking about the interior of the manufacturing facility. And then when you think about a PPE manufacturer and they're basically the first manufacturing facility in the United States, we want to also make sure we're looking at the research and development aspect of that. They traditionally supplied everything from Asia, but obviously in the United States, there's research and development credit opportunity there, depending on how they are going to design the lines and even, the building towards some of the energy efficiency management systems. So, we're going to look at those four big buckets of credit, incentive, deduction, and rebate, so that we can go to the power company and talk to them about, our energy efficient management system in the facility. All 7 of the items I pointed out really are applicable in this case study as you go through them. So, inventory methodology is going to be important when you think about inventory management. The facility management is going to be very important from the standpoint of warehousing and what we refer to as an energy management system lights out approach. And so, again, what I often say is in the supply chain, yes, you're looking at, various incentive packages, and you're looking at state, you're looking at international, but the backbone of any supply chain, whether it's the elasticity of it or potentially the gaps in it, is going to have a tax aspect to it at the federal level, state level, certainly the international level, because all supply chains are international. And then as Pete correctly pointed out, the new market tax credits are areas in the country that we can gain significant capital, let alone tax equity investors, as a couple of the examples that Pete highlighted. So really a lot to work here. Just have to take a holistic approach to it.
Yeah, that's great, Ron. Yeah, and again, I know we just went over a couple minutes, but hopefully what everyone that's still on with us, which is the majority, appreciate you staying on. It goes back to, we can't just look at one aspect of this. It's really focusing on the overall business. I think Pete said it well, is what's the business objective? Where does the business need to be located? And from there, we can start that planning process. So with that, and recognizing it's 12:03, we will conclude this session and really conclude our 2021 Industrial Virtual Conference. Really appreciate you all joining us. Thank you to our speakers in both sessions today. Very timely insights. I know that there were a very few number of questions, and we know there's more out there, so please reach out to us about any of the topics we discussed today. Our contact information is up right now. Also on the survey, really appreciate your feedback and know that we're going to be using that feedback to create content going forward. So lastly, just again, honored that you took time out of your busy schedules. We hope you found the sessions beneficial. More to come from us. Please stay tuned and know that we're here to help however we can. So thank you for joining us, and hope everyone has a wonderful holiday season.